Okay, finally gotten around to starting the video, guys. So welcome again to our little community, and let's get into it. All right, so GU daily chart, continuing from where we left off last week. Again, this is going to be the last one for the look back series. Okay, so go ahead, pause the video, analyze your daily chart. We're mainly going to be using most of the levels that were on the last chart. So if you had those saved and you're following along, you can go ahead and pause and mark up, and then we'll discuss now. Okay, so this arrow here shows you the start of the week. So that was Monday, Tuesday, Wednesday, Thursday, Friday, and then this is today. So I'm gonna ignore this candle since it's a previous week's look back. All right, so here we have price trading and closing above this down candle. All right, so that makes this a possible bullish order block. But what does that mean? Does that mean that I'm just going to start buying here and put my stop loss down here and wait for it forever to keep going? No, that's how people lose money, right? You have to have a criteria or something else besides a directional bias to be profitable. Because if you know that this was a bearish market and you sold it here, you would lose money, right? So knowing that this is an order block or knowing that this is a possible order block does not mean that you're going to buy here and win. What it means is you have an area now that you can start focusing on, and you know what you want to see there. And then that would mainly be whatever your entry pattern is. If you're going to put a line here or a box there and call it your POI, and then you drop to a lower time frame, and let's say you trade moving averages, trend lines, stop points, whatever it is that you trade as your entry pattern. Once you zoom into this area or you put a box on it like that, that's what you look for in this area. And you start looking once this candle opens, because you want to be buying down here so you can get all that expansion, all right? Cool. So if you did that and you're able to find the entry pattern as price opened here and trade lower down into this order block, then that would have been a really nice trade, roughly about 100 pips at least. One day, price gets to your target, or price gets here rather, and then it drops. Buying here and holding all the way up is not, it's not suitable for everybody. Because if you bought here and then this reached like $1,000 and then it drops to $600, some part of your mind is going to say, I should have taken something or taken partials or close the trade. All right. Personally, again, I don't trade like that. But once you identify your entry, and for this example, we're basing our entry off this order block, then you need to identify where you're going to exit as well. All right. So all of this right here, ICT, CB, could look for entries here on a lower time frame and then scale out. All right. Well, this is Monday, Tuesday, Wednesday, traded back down into the order block again. Give you a nice entry, and then that's another trade for the week. So by just identifying an area where it's likely to see bullish setups form, you could have gotten two really good trades that basically look like at least 100 pip. So that's 90. Yeah, both of them are like 100 pip each. But then that's going to be largely dependent on where you got out of the trade. All right. But in terms of entry, just identify the order block is enough. This price level here, 1.3554. I'm using that to frame the high on this order block. Here, if you hover over the closing price, you see the high as 1.35545. I think that's actually wrong. 35545. I have 54. No issues. Oh, it's actually correct. No idea why it's showing that then. 35545. There. Yep. Oh, I guess it's anyway. We're gonna drop to our hourly chart now, and we're gonna break down actual setups that formed and what was possible. So let's do that now. All right, so GG hourly chart. We're here last week. I'll explain all of this. So now, take a moment, pause, analyze here, and then I'll show you the annotations I have. Okay, so I kept these on from last video to explain and kind of pull back on something we did over here to show you how it works out here again. So if you remember what we did here, price had formed a high here, traded low, back inside of this small range, and then this, after this made a low, really didn't go anywhere and started trading sideways. So because of that, we used this as our trading range right here, and we had projected it 3 deviations to end here, and then for safety, we'd aim for at least 2 deviations. So once it gets to here on this candle, we have to be at break even, and majority of the position have to be taken off. And if we're lucky, then we get this right here. And when you look at right here, down here, we see this peak being formed, or this low, small range created, same like here, back inside the range, and this push, which will be the same as this push. So we use this as our range right here, put a box around it. All right, and for this one, I didn't use these wicks. I mainly focused on the lows here and then these highs in here. I didn't use these wicks because they're way too far from the bodies. So whenever the wicks are like way far from the bodies, I tend to not like the inconsistencies that happens when I use them. So I just stick to the bodies. And if I fall short of a target, then that's it. It gets me exactly there, then that's it. But I don't change that rule. And people have different rules for them, but based on how I learned it, what I understand, and what I'm comfortable with, I just don't use them when they're this far away from the bodies. For my range, I use them for something else. But yeah, so that's my range right there. Predicted 1, 2. For safety, if I get in, that's my target. Ultimate objective, 3 right here. Okay? Straight up. There's a small consolidation happening right here. And I'm using this down candle here inside of the consolidation as an order block candidate. Why? We're bullish right here and expecting price to trade to at least here and then here. Price traded to a high right there in a bullish market. If the market is bullish and it trades to a high, I'm not expecting it to be raiding stops and then dropping, because there's more upside for this market to push to. So with that in mind, when this down candle gets formed right here, I'm looking at this as a possible reaccumulation inside of this range for a push higher. What do I want to see once I see this? I don't want to see price closing below this down candle. Right? Price closing below this invalidates the setup. So we have the bulk of price sustaining here. This is one of those times when you have to be flexible in your analysis, simply because these broken lines represent midnight opening price. Asian session is really not going to start a big move and violate order block like that. Not in this context. So that's not something I was looking for. I'm mainly looking for price to come here, reaccumulate, then push. So that in mind, you can break this portion down of price action, find a whole lot of setups that could push you higher. Push that order block out in time and see how price got to third objective or the third deviation of the range. Then it trades back down into this price level, 1.35545. That price is the high of the order block that we saw on the daily chart. This bit of price action here on a 1 hour chart, this is what the daily order block looks like. So the high of this day right here, that's the order block high. So once price goes above that line and it's coming back down into it, that's price coming down into the order block, and you can expect a push. So once you see that price broke this line and it's coming back down, you start identifying the areas where if the market is bullish, it shouldn't go back below those areas. And in this case, it would have been this down candle. We don't want to see it going back below that if the market is bullish. Stay there, reaccumulate. Order blocks are in here, then it pushes. Came back down again, same thing. It's back into the order block. If the market is still bullish, we don't want to see it closing below. It didn't close below. Really good setup. Cool. So yeah, as far as how I use previous week's data to look at that, all of this was possible last week. Everything that we've done so far, we've done it all in hindsight, but now you can just go over and see how it plays out, how you could have used that to plan, and then going forward, you know what to look for on an hourly chart when you're planning for your week. So with that out of the way, let's jump into the questions that we have. And first question I have is, how to know when to use mitigation order block turtle soup when market is retracing. Those are all ICT mentorship stuff, so I'm not going to go into that. What makes an order block invalid? So what makes an order block valid first? If you understand what makes an order block valid, then you'd understand what makes an order block invalid. And I'm not saying that to make anybody feel like they don't know what they're talking about, but you want to develop a sense of demanding what you want to see before you engage. So you have a reason to believe that the market is bullish. What do you want to see to buy? You don't just see a candle going up and buy, right? There are certain things that bullish markets do, such as they raid lows for stop points and they push and they take a high, right? So based on how you trade, are you going to wait for the low to get raided in a particular session and then trade? Or do you want to see the market take a high, break the range, and then the retracement is what you look for? Based on whichever one of those really jive with you better, after the low gets raided, for instance, right? Let's say you're going to go with, if the market is bullish, I'm going to buy all the stop points. So buy the dips, really. So if that's your plan, then you're likely going to be trading in London because most stop points happen in London. And then what you're going to do is you already know where the lows are. You can identify those long in advance before London session. So let's say we're using this low right here. I'm going to buy this low if it gets rated and I think the market is bullish. So identify London session in this day, London session in the next day. This day didn't rate it, so no trade for you. That's simple. Next day, you don't care what's happening up here, you're waiting for London to rate it. Or if you're flexible and you're just going to trade any stop trade, then that's your trading plan. You have to decide that part on your own. This is the low. There's a huge raid of the low, right? It raises the low, but when do you buy? Do you just buy when this candle starts to go down? No, that's crazy. You want to see the low get raided, and you want to buy the order blocks that are formed at the low, which means if it trades through here, and this is the down candle, you don't buy until price breaks that and validates the order block. So this is the down candle. After the low gets raided, price trades through here. Because you already wanted to see this low get raided to buy the order block. The order block forms after the low gets raided here. So in terms of risk, I feel more comfortable buying this and putting my stops down there because I'm following rules. So if I get stopped out, then okay, did I enter too early? Was there another stop hunt? Did I enter in the wrong session? But something is going to stand out why I lost. So I can fix that going forward, right? I can see that my stops were too tight. Maybe I should have put it down here. Maybe I put it on the order block here, and then maybe this tagged me out before any of this. So then I can say, okay, cool. If I enter the order block and it's still within the same session, so I entered in London session, and in London it's still down there, am I going to cut the trade, or am I going to give the trade more room to breathe, just in case there's reason for it to raid these again? That's up to you. And if that's the case, then you can't use the same lot size that you would use if your stop is here, and then keep that lot if your stop is down here, because you're assuming more risk. So if you're going to put your stop down here, you're either going to wait for a better entry so you can risk the same amount, or you're going to cut your lot size and then enter the same place. That way you keep the risk controlled. No wild spike doesn't get you, right? That would have been lovely. Cool. So that's how I validate my order blocks. What do I want to see before I enter? If I see that, whatever that thing is, in this case, it was a stop hunt. If I see that stop hunt, when did it happen? I don't want an Asian stop hunt because Asian range usually gets rated. I want a London stop hunt because those typically form one extreme of the day. So that's that. Next question, can I explain market maker sell model and buy model? For that, I recommend going to ICT's YouTube channel. Explanation there is perfectly fine. How do you know when you're on the right track? Okay. For me, I feel comfortable with my trading if I can take a trade and whether it wins or I lose, I understand why, right? It's not like, and this is why I stopped trading retail. I stopped trading trend lines because when you buy a trend line and it rallies, you really feel like you can trade. But when you buy a trend line and it stops you out, you just cannot understand why. Like, why did it break the trend line? So once you have a system in place that allows you to outline your winning trades, outline your losing trades, you're following the same setup, you're risking the same. If anything goes off in your model, when you're reviewing your results, you can see that, oh, my setup said buy the lows, but I didn't wait for it to read the lows and then trade down into a higher time frame order block. Or it rated the low here, but there was really nothing in here to support bullish prices. I should have waited for the candle to close and then I get in. Something like that. Things like that help you to improve. You can say, oh, I entered this early. I should have waited for London session because it wasn't London session yet. Things like that. Identify your winners, why you won, why you lost. Keep doing what makes you money and fix what's causing you to lose money. How do you determine the bias at the beginning of your trading day? The bias at the beginning of my trading day is usually, well, unless we're talking about Monday, because on Monday, I would have completed my analysis over the weekend and I'd know what I'm looking forward to for the week in terms of, where the news drivers are, where was liquidity swept last week, where's liquidity resting now, what are most traders doing, where are they hiding their stop losses that the market maker can raid. Stuff like that gives me directional bias. So if I'm bullish and then Friday was bullish, I'd likely want to see the market trade and target the buyers from Friday, and then I get in. So that's how I determine my bias from the start of the week. And then I monitor if my levels get hit. So if I'm bullish up to a particular point and that level gets traded to on Monday, then I don't know what to do for Tuesday. I have to wait for more information. I have to look what's happening. Did it break the high and continue? Did it trade up to the high and then retrace? Something. I need more data. So that's how I determine my bias. I'd like to know how you take partials. So partials is a tricky topic because what do you want to gain from taking partials? For me, I like the number 250. I just do. I feel like when you're trading and you make $1,000 profit or multiples of 1,000, your account grows faster. Is that a lie? Yes. Does it make me feel comfortable when I'm trading? Yes, it does. So that's something I keep with my trading. So because of that, if I'm taking a trade and I'm able to scale off based on the account size and the lot size I'm using in that trade, can scale off anywhere $250, $500, $750, $1,000, $1,250, $1,500, that type of thing. I will take that. If I'm trading a tight range, I like the idea of 80% of the trade off. And it's one of the things that I learned as well. 80% off is good. You have the bulk of the money in your pocket. Whatever happens to the next 20%, you should be at break even either way. If you get stopped out at break even and you only get 80%, you should be fine. No greed. You can't lose, obviously. Do I have a fixed target for 15 to 20 pips? It depends on the setup. Some setups are framed around really tight ranges, and the ranges themselves are 25 pips. If I'm going to demand the 25 pips from a 25 pip range, then it's going to require a level of precision that is not always possible or available. So if I want to day trade 20 pips daily, I need to be trading a range that will allow me to get in maybe a couple pips later and still get my 20 pips. So I want to be trading a range that's more than your pip objective. So if you want a 10 pip trade a range that's maybe 15, 20 pips or higher. If you want 20 pips, trade a range that's higher than 20 pips, basically. How I get my ranges to trade. So the idea that most persons say, trade what you see. That's what I do. So I'm looking at a high and I'm looking at a low, and I'm looking at how does price behave after that the range is created. If we have price thawing in the range, okay, cool. I want to know where the range high is, where the range low is, and where the order blocks are in the range based on my bias. If I'm bullish, then the bullish order blocks should be supporting price. So the low should stay intact, and then we should be running at the high. And then the reverse for bear scenarios. So that's it. I stay in the range, I play the range until we break the range. I break the range and I get stopped, then that's fine. and then I wait for retracement to continue. But usually, if you're going to be trading a ranging market. Is it that the market has already been bullish, like here? Let's say this is a bullish market. So let's say it's bullish and it starts to range. I really am not interested in being in these sells because the market is bullish. I'd rather take all the buys down here. So if it breaks out with me, I'm not worried about getting stopped. It's breaking out to give me more money, and then my stops are breaking. So always remember, higher time frame is for directional bias. Lower time frames are just for entry. Lower time frames are not for directional bias. That's just what I think. It makes more sense to go with a higher time frame for directional bias. How you pyramid? You pyramid at logical levels where price structure supports your bias. So I'm bullish here. So order blocks that are formed here, once they're validated, I'm cool with buying that. So another down candle here, I'm cool with buying that too. This is a raid. If it's in London, I'm cool with buying that raid in a bullish market because it's London session. Trades to a high. It's another consolidation. Market is still bullish because they're still objective up here. Then I'm cool with buying these lows being raided, buying order blocks inside this consolidation. All of that. That's how you stack positions. Okay. Next up. Okay, that's something else. Yeah, yeah, it's gonna take a lot of practice. The thing about practice is it's similar to how you journal and how you backtest. Most people backtest scenarios that play out and they just find the order block where the market moved aggressively. And then they say, if you put your stops here, you put your take profit here, you would have made money. I don't do that. If I'm backtesting a chart, I'm looking at how it played out. Yes, an order block was formed, fine. Down candles pop up on the chart all the time. What made this one a good one? Where was it formed? Is there any higher time frame idea that supports it? That type of thing. That's how you filter out which order blocks to use. What is the context around them forming? If I'm bullish and I see a bearish order block formed, I don't care about that. I'm looking at it because it's there and I want to see price destroy it, but I'm not going to be looking at it and say, oh, it's a bearish order block, let me sell. No. So practice those things. This week, for instance, let's say you were reviewing this week. Right now, you weren't participating in all these moves, but you saw that the market was clearly bullish. Okay, where were the best entry patterns formed? Within this area around these order blocks. Okay, cool. What made these order blocks so much better? Okay, this is a down candle on a daily chart. This is a higher time frame bullish order block. So a lower time frame bullish order block being formed there supports the idea. Okay, cool. So going forward, if I see a higher time frame order block and then price trades up to it and creates an order block of the same directional bias, okay, I can look for that as well. That type of thing. This question is about art. As I mentioned before, art is not ready to come out yet. The last question is how to determine if price will go take the outer or inner liquidity on any time frame. Again, remember, higher time frame is for directional bias. Lower time frame is for entries. So if I'm bullish on the higher time frame, when I drop to the lower time frame, I'm looking for where the liquidity is that I can trade. So if I'm going to be trading this low, I'm bullish. I want to buy that low. You know, identify that lower time frame low, know that the higher time frame is bullish, then you just wait and you get in. If a lower time frame range is formed, what you pay attention to is the same thing we always do. What's the range high? What's the range low? Did it break the range? All right. If it's going to retrace, where are the structures within the range that supports the idea that I should be a buyer? Then you start looking at your entry patterns. So I did share 2 entry patterns last week. 2 pretty easy ones, type 1 and type 2. If you look right here, we have 1, 2, 3 push. So type 2. You buying at the rate of these lows. For confluence, there is nothing inside here that supports or nothing exactly at this low. So a run out or a rate of this low doesn't have to stop at the low, just tag it and move. It drops lower sometimes to reaccumulate. So we have the lows right here, and we have the order blocks down here. The order blocks now give you context because I want to see the lows rated, but I don't want to see the order blocks being violated. So don't buy here and put your stops all the way down there. You wait for it to come down to the order block. And then if the order blocks get respected, then you take the trade. If you take a trade preemptively before the order block gets validated and it gets stopped out, that's a really small risk because you waited instead of if you took the trade up here, that's a much wider stop. So these are the little things that we do differently and we see differently, and it makes our results different. All right, so this one is getting pretty long. I don't want to have you guys falling asleep, so I'm gonna stop it here and see you in the Telegram channel.